Well, let's start off with the broad economics picture, because we had that inflation number coming in yesterday and coming in lower, a decline to 11.1% year on year from February. And some would say coming at us as a surprise, where we've got globally the threat of rising inflation plaguing.
Well, I can't say I'm surprised because, you know, for the past 6 months or so, 4 to 5 months before December, the inflation rate has been coming down until January, when we had a spike. And that was attributed to the expenditure or the spending during the festival period of December through early January. And thereafter, in February, we have a downward trend again in inflation. But let me tell you that we don't expect this to continue, because, you know, government spending is on the increase, and again, election campaign expenses are also very high. And one thing you should note is that there is a lag effect of this spending or increased liquidity into the system. And so what you expect is that in this quarter or second quarter of the year, expect inflation rate to have a spike, and therefore the ability of government or the central bank through its monetary policies to bring down inflation rate toward the end of the year, it depends a lot on how high inflation goes immediately after the election or around the election period, and then how effective CBN policy in terms of open market operations, liquidity ratio increases, and monetary policy rate increases, which I expect in the second half of the year, how effective it is to be able to tame inflation to single digits before the end of the year. But I can tell you that that will be difficult to achieve. I still expect inflation rate to be around 11–12% by the end of the current year.
Having said that, what's your outlook, Yomi, on the interest rate front? You know, what do you see being the trend for the year, where, of course, we've still got growth and managing economic growth to contend with, where risks are projected that we could have 7% growth coming in this year?
Yes, I expect that it's about 7%, slightly above 7% GDP growth we should be able to achieve that in the current year. Although there are downside risks to that growth rate. One is the fact that it depends a lot on the outcome of the election. If the election turns out to spike political and social crisis, at the end of the day, you will expect that it will affect what we can achieve in terms of GDP growth rate. But like I said, I don't expect that to happen. Again, you see trends in the global economy, because Nigerian economy depends a lot on the revenue from crude oil exports. And these, you expect, also depend a lot on international or global economic growth rate, which, again, can be affected by things like volatility in financial markets, euro area debt crisis, and the tightening of fiscal operations by most countries because of spike in inflation in those countries too. But all the same, I expect that this year, all these factors can only moderate the global economic growth rate rather than reverse the recovery mode that we have currently. So I expect that at the end of the day, we'll be able to achieve a GDP growth rate of between 7% and 8%.
Of course, we've got that weaker currency to contend with as well, Yomi. We saw the Nigerian naira weaken to its weakest point in 18.5 months ahead of these elections that we've been speaking about. What's your outlook on that currency front?
Well, like I said before, I don't expect much of depreciation in the course of this year, because a lot of factors still favor the Nigerian government or CBN being able to defend the value of the naira to a large extent. One, because you have the trend in crude oil prices, which is still going up, and we expect that to a large extent it will remain high for the rest of this year, and therefore you expect that external reserve will move up. Or in fact, it's already moving up because it has moved from $32 billion by the end of 2010 to about $36 billion currently. And so I don't see much of depletion of foreign exchange or external reserves in the current year. And so that will put the Central Bank of Nigeria in a position to be able to defend the value of the naira, because it is determined to do that. and the resources are available actually to do that. So speculative buying of foreign currencies currently based on the IMF position, I think over time will ease off and will have things normalize, and therefore exchange depreciation is not expected to be much in the course of the year.